Real Estate 101 with Boyle Team Real Estate.
Hi everyone, it's Marlene Boyle from Boyle Team Real Estate, and we're here today with Ceilidh Lock, and Ceilidh is from the Mortgage Center. Ceilidh is a mortgage broker with the Mortgage Center, and we're here with Buyer Series episode 4 today, and we're going to be talking about the down payment that's required when purchasing a home, whether it's a single family residential home or whether it's an investment property. So Ceilidh, welcome. Thank you for coming.
Thank you.
Ceilidh, can you tell us a little bit about yourself, where you grew up, your past experience in business?
So I always grew up living in Durham Region. I lived in Ajax, and my family and I moved to Newcastle. We've been there for 10 years now. I have 2 small children, and I went to the University of Guelph for economics, and then I started working in the bank, but I've now done mortgages for the past 8 years.
Okay, great. And what did you do at the bank? Did you do mortgages?
I did mortgages
as well?
and investments at the bank as well.
Okay, great.
Yes.
So you have a lot of experience under your belt.
Yes.
And you're a mortgage broker, so
Yes.
that is actually a higher class. Now they've classed them all, I understand.
Yes, they have mortgage agent level 1, mortgage agent level 2, and then mortgage broker is the top. So there's just different lenders you can submit to, different programs you have access to based on what level you're at.
Okay, great. Well, congratulations on getting your
Thank
brokerage
you.
license or broker license. So let's start with down payment. What you need, this is the biggest question. Can I get away with having 5% down purchasing a home for myself? We're talking single family residential homes.
Yes. So the biggest misconception and the biggest question we get asked is, can I buy a house with 5% down, but I'm not a first time buyer? So anybody that is buying a single family residential home to live in can put 5% down as long as they qualify based on their income. So if it's their second home, their 10th home, even if it's a cottage, as long as they're going to own or occupy that property, they can put 5% down or the minimum down payment required based on their income.
Okay, and then obviously they're going to have an insured mortgage at that point.
Yes.
And then their credit is going to affect how much they can put down.
Yes, based on what they qualify, based on their credit, their past credit history, and their income. As long as they qualify to put the 5% down, then they can do that, or the minimum down payment required.
Okay, and then what other down payment requirements are there, like for 10%, all that? I mean, obviously it's the same credit and whatnot factors.
Yes, so it depends on their income. As they get different income levels, if they need a stated income program, some programs require 10%, some programs require 20%. It just depends on their credit. If their credit, they have bruised credit, they might require to put a bigger down payment depending on that if they can't
Bruised credit.
That's
interesting.
So the way we call it, yes.
Never heard that before. So a question I wanted to ask you was, we specialize here at Boyle Team with a lot of country property farms. I know it's harder to get a farm mortgage, and also for country property, a lot of the lenders require higher % down if it's well septic.
Yes.
Is that strictly A lenders or B lenders, or can you elaborate a little bit on that?
So there's lots of options. If they are buying a property that's just well and septic but still zoned like agricultural or residential, if it's a farm property and it's zoned strictly agricultural with lots of acreage, they probably will require a bigger down payment than 5%. If there's under 5 acres of land or 5 acres and under, and not a lot of outbuildings, no livestock, then there's still options to put 5% down with the A lenders as long as they qualify.
Okay, and then B lenders. So let's just clarify to everybody, the A lender is obviously better.
There's like 3 tiers of lending. So there's A lenders, B lenders, and then there's private lenders. So A lenders would be somebody who has like traditional income, job letters, pay stub, not self-employed, depends, and good credit. B lenders would be somebody who's had some bruises on their credit, maybe self-employed and needs stated income, or to use bank statements for their income instead of their tax returns.
Right.
Self-employed write most of their taxes off. And then private lenders would be maybe somebody who doesn't have the income at the moment and has bruised credit, or a mix of both. But there's 3 different options for those.
Okay, so when A lenders, you could possibly qualify for 5% for well and septic, but then B lenders, is it a definite yes, you need
20% down?
20, if not more.
Yes, if not more. The more rural you get and the further out into the country, it's a little bit more difficult for B lenders. They like to be in city centers so that if there was an issue, then they can resell the property easier.
Right. And I know this is huge, so I
Yes.
hope everybody's listening to this, because people don't know, the general public
No.
don't know this, and they'll call me, I wanna buy well and septic property, and I'll ask them, a lot of people don't know if they're with an A or B lender.
Yes,
And they're like, I don't know, and it makes a difference.
And there's a lot of properties with acreage now. So if they're buying a property that has 10 acres, and a lot of the times the bank will appraise the house plus 5 acres.
Correct, yes.
So if they have an issue with the value, if it's 10 acres, then that's where they could run into problems. But if what they bought the house for and the house plus 5 acres still appraises at that price, then they shouldn't have an issue.
Okay, no, that's good information. So what about, let's go to rentals. If somebody's buying an income property.
Yes.
And there's 2 different scenarios. One, they might be living, it's a duplex, they're living in the top, renting out the bottom. What's the scenario for down payment there?
So if somebody is buying a single family residential property to make it into a rental property, and there's
Okay.
only 1 unit,
Okay.
they have to put 20% down. There's no way around that on
Okay.
that side. If they are buying, say, a duplex and they are going to live in one of the units,
Yes.
then they can put the minimum down payment again. So they could put the 5% down or the minimum down payment required depending on their purchase price.
Right.
So they can use that rental income from the other unit to help them qualify for that purchase while still putting the minimum down payment.
Okay.
If they're buying a triplex or even a fourplex, the minimum down would be 10% if they're going to live in one of the units.
Okay.
So as long as they owner occupy 1 unit, they could put 10% down or the minimum required
That they
depending on the
qualify
purchase
for.
price.
Right, but the minimum if you qualify is 10.
Yes.
And then if they're not living in one of the units, again, even though it's a triplex, fourplex, 20 again.
20%, yes.
And then what about if it's a single family residential home that they're buying as a second property for their child, like their child to live in, their in-law, like mother, father, in-law to live in?
Yes, so they can, there's a second home program, similar to like a cottage property.
Okay.
They can put 5% down, but we wouldn't be able to use the rental income for that if
Okay.
it's going to be a family member or somebody in the property for the A lenders.
Okay, so then back to the cottage can qualify for 5% down again if they qualify.
Yes.
So that's good news, thanks for people to know that.
Yes, there's different types of cottage properties. So if the property is on river water or lake water, and if the property is 4 season with year-round road access, some cottages you can put 5% down, some require 10%. It depends. If there's not year-round road access, the cottage is on block foundation, then they might require 10% down.
That's interesting. It's good to know. So Kaylee, I know that you're saying it's 5% down, 10% down, but is there not a rule, I think, for over 500K mortgage, if you have a mortgage for over 500,000 and even $1 million, there's different tiers?
Yes, so you're able to put 5% down on the first 500,000. So say you're buying a property for 600,000. If you qualify, you're able to put 5% down on the first 500,000. So that would be 25,000.
Yes.
And then on that 100,000 over to get you to the 600,000, you would need 10%. So it would make your total down payment for a $600,000 property $35,000.
Okay.
As long as you qualify.
So max 5% is max 500.
Yes.
And then what is the 10% up to?
To $1 million. So once you get to that $1 million mark, unfortunately it's 20% down that's required on anything $1 million or over.
Okay, so the tiers are 500, $1 million, and then after $1 million it's 20 no matter what.
Yes. Once you get over 1.5 million, there even are some lenders that will require another tier. So on the first 1.5 million, it would be 20%, and then on everything over the 1.5 million at some lenders, it would be 50% required.
Oh wow, okay.
Yes. So when you get to that $2 million mark, it's a little bit bigger down payments required.
Now, what about somebody who has a high income? Does that still take into effect? Like, is that still applicable to them?
Yes, yes.
So
Unfortunately, once you get over the 1.5, for majority of the lenders, it's 50% on anything over that. So it would be tiered, 20% on the first 1.5, and then 50% on that extra 500,000 if they went to 2.
Okay, that sounds good. Now I know we're talking back to the insured mortgages, so basically it's anything under 20% down, is that still?
Yes, is an insured mortgage.
Yeah.
So an insured mortgage means that CMHC premium or Sagen, one of the other insurers, they would get added to the mortgage as kind of like an insurance to the bank, because there's not a lot of equity in the property. If something was to happen, that is like a secondary insurance for them.
Okay.
When they're an insured mortgage, you can only do a 25-year amortization. When you
Okay.
put 20% down, or if your mortgage is not insured, you're able to do 30 years, and even some lenders now 35 years on the
Oh,
B
wow.
side.
Okay.
Yes.
Wow. So with the insured mortgage, I know there's rates differences. Some people think,
Yes.
well, I don't want to put, maybe you can elaborate. I don't want to do an insured mortgage because I have to pay the insurance premium. But sometimes they have incentive for interest rates that
Yes.
actually kind of,
Offset a little
Yeah.
bit, yes. So for insured mortgages, the rates are normally lower, because for the bank, they have that extra insurance, and a lot of their investors, or the ones that are offering the rates, will give a lower rate because they know that they've got that extra level of protection there.
yes.
So insured mortgage rates right now are quite a bit lower. You can find them in the 4% still,
Okay.
high 4%. If it's an uninsured mortgage, they're creeping into the 5s and mid-5s, depending
Yeah.
on where they're at.
So on an investment side, where
Yes.
sometimes it's better to have the mortgage because you can write it off,
Yes.
they may be better to go not insured because they can get a better rate.
It depends. If it's a full rental on the investment side, they don't have the option to go
Oh.
insured, because they need to have that 20% down. If they're going to live in
Yes.
one of the units, then yes, they would be nice to live in one unit, get the insured rate, and help with the rental income for the
Okay.
other unit as well.
Okay, so just some little ideas for everyone out there, just different tips and tricks and.
Yes, there's lots of
Things
different
that-
options depending on the property type that they're going to buy. There's lots of different ways to help boost their qualifying to buy maybe a bigger property or get a bigger purchase price, especially if it's a duplex and they're going to live in one unit and use the rental income to help them qualify for more on the other unit.
Okay, so that's basically down payment. Anything else to add to the down payment or any other?
I think the biggest thing would be is that it doesn't matter if they're first-time buyer, second-time buyer, cottage properties, is that anybody can put the 5% down as long as they qualify. That's the question we get asked over and
Yes.
over again. Most people call, they want to know, because
Yeah.
a lot of people think you have to be a first-time buyer for that 5% down,
Yeah.
which is not true.
Okay, so thank you very much, Kaylee, for coming out and sharing your knowledge with us. And I just want to ask before we, close up here, do you have any recommendations to the young population of anything that you would, any type of references to read or to learn, or anything that you would have done differently?
Yes, so I would just tell anybody looking to buy a house, the younger population as well, get your options, find them out. Even if you're not ready to buy right now, it's good to know where you stand so you can make yourself a plan, whether it be a 1-year plan, a 5-year plan, or a 10-year plan. It lets you know where you're at and what you would need to do to work towards buying a house in the future, whether it be save more down payment, look for
Right.
other sources of income, find a co-signer to help. There's always options, but it's hard to get a mindset to look to buy until you know those options or until you make that plan.
And I agree totally with that, especially looking. We look, and
Yes.
the first question we ask is, are you pre-approved? Have you
Yes.
been to talk to somebody at least? And the majority haven't, they don't know.
Yes,
So-
and you don't know what you don't know. So a lot of people don't ask those questions, and they could be approved for a house. A lot of them
Exactly.
assume that it's never in my realm to buy, but they're paying more in rent when they could just make a little plan and then get themselves to buy within
Right.
a year, a lot of
Yeah,
them.
yeah. Well, thanks again, Kaylee.
Thanks for having me.
And thank you, everybody, for watching this episode. Have a great day.